Hi everyone, so we are trying to analyze the euro dollar daily chart here. So where are we right now? We've come all the way from the March lows of 106 up to just below 124, and now we're seeing more weakness in the market. So in terms of current candlestick patterns, what we can see is probably there's the formation of a head and shoulder. So I'll start the left shoulder from here. Most likely I think the head would be around here, and what's not yet formed is the right shoulder, but we'll assume it's just about here, and it would be retesting this neckline. So let me put this neckline more clearly so you can see what I'm doing. Okay, so where are we right now? We are about 180, and in all probabilities where we're going to retest is this level. Okay, so around here, 1, 2, 3. And in terms of prices, what we're talking about is we've done 116, 117, and possibly 117,800. Okay, so that's going to be a rising neckline, and around here, that's where we're going to see more volumes and more activity going to surge in this market. So in this current setup, what could be a target for this head and shoulder? This would be maybe the farthest that this pattern will give in terms of target, okay, head and shoulder. But in 99% probability, it should give you the distance from the right shoulder to the neckline. And in terms of price, we're talking about 112s. But the farthest what it could go is just below 110, okay, so 109,500s. How can I support this is I'll apply Fibonacci levels. So I'll apply it from the lows of March 2020, that's the COVID low, up to the recent highs what we've seen. And yeah, I see that with these manual targets what we've just drawn, they coincide more or less with important Fibonacci levels. 61.8% would be just above 112, so that's more closer to 113 actually. So 112,800s or 900s would be a fair target for euro dollar when it comes down, and the farthest that it could go is just below 110. Okay, so we've drawn manually the targets, and we've also tried to verify these targets using Fibonacci levels. So for those who've traded this, they should hold until you see a break of this neckline, and that should give you a swift target down. Also, what we need to point out is we've had successive green candles in the past when it was trading in this region. So very likely this move would be swift. Okay, so we could see just one big red candle coming down here, especially because all the traders who've gone long at this point and haven't booked, I'm assuming they've all put their stop losses just below this point. Okay, so it coincides with a swing low, it coincides with a Fibonacci retracement level, and it has all the ingredients to give a swift move just below this target. Okay, so for those who haven't taken this trade yet, they should wait for possibly a retracement up to the 20 DMA. Okay, so this green line here is a 20 DMA, and I use it quite often to analyze charts because once we go below 20 DMA, it's more likely to pose as a resistance. So short around 120s if the market pulls back would be excellent. Okay, and then we await the break from here, and I think once we break this we should go directly to just below 115. Okay, so that would be 114,900, and however I think there would be quite a swift pullback to retest this neckline. That's where, if people haven't gone short at around this point, they should consider going at this point. So 118 again, but here your risk reward ratio won't be as good as it is here, because at this point you would most likely put your stops either just above the right shoulder, which is 122, or for more safety, just above the head high, which is 123,500. Okay, so, but this market is not going to swiftly fall. It's going to consolidate and do what we call waves. So that's one wave, two waves. It will reach this level after retesting the same low, again consolidate, and then give a final move to here in most probability. Okay, so I wouldn't advise holding 100% of these positions if you're going short up to this point. If market does this, so in between 112,800 and 114,800, that's where you would book around 75% of the positions, and maybe leave 25% remaining just in case market retraces further and gives the 110 level. Okay, but at this point, I guess more buyers will flock into the market. Okay, so very likely this is going to be support level. If we go into a higher time frame, so that would be weekly, one important observation is that after a very long time, so these candles, one candle is 1 week, so after a very long time, we're seeing is a big move down. Okay, even this big move up is very small related to this one. So in this candle, we can see two things happening. First is we've breached the 20 SMA, and second, we are closing the week below the 23.6% level. What this means is this pattern has reversed. Okay, so whenever we close below 23.6% retracement levels, it means the previous pattern has reversed. What we can see is all this while market was going up, it tested this level, couldn't breach, it came down, it gave exactly this level. Okay, it gave 23.6% level, bounced back, retested, couldn't breach this down, but then found support at 38.2 level, retested again, breached this upwards this time, no new high. That's when market starts to dip, and in most probability it will come to retest this level before breaching. Okay, so now let's move from technical updates to more fundamental updates. Just a quick recap about what happened in the market during the week, especially on the side of the Fed. Don't forget that the Fed has now indicated that at least 2 hikes are going to happen in 2023. But what's really changed is that more members on the Fed board are now supporting this move, which makes it more certainty than it was before. And this is what we call tapering. And after this indication, that's when we've seen the USD picking up. I have the DXY here. DXY is up to 92. It was just below 90s level before. And this is obviously impacting the euro dollar. So more weakness is coming from the dollar appreciating than the euro depreciating. 5 things to watch, that's from Reuters. During the weekend, there's ECB policymakers meeting, and there are a few important points that are likely to impact the euro dollar, which are on the menu, especially when we talk about inflation targeting. And what more we have for next week is a full packed week with important data coming out, starting with Monday 21st when ECB president will speak, and very likely it will add more volatility to the euro dollar. And Wednesday we're going to have PMI data which are likely to give a great indication on how well the euro economy is settling in post-COVID. Okay, so these are really going to impact the euro dollar for the coming week. And just to summarize, don't forget to, if you're going to trade this from the short side, don't forget to place your entry levels at 120s level, your stops just above if it pulls back, and keep a keen eye on 117 and 117.80s for key breaches so that we can have a continuation of this pattern. Okay, and upon breaching this point, we'll have a confirmation of this head and shoulder pattern.